Okay, so it's 3:50 now. I'm not going to give you our 15 minutes, so we're going to stick to our 75 minutes time. It's a great pleasure for me to chair such a distinct panel of panelists. I'm going to give a very quick introduction, so I don't take from their time. And the topic is, of course, going to be something which all the speakers were basically alluding to, which is the topic of uncertainty, structural changes, and the implications for monetary policy and fiscal policy as well. I apologize in advance because I'm going to be a very despotic moderator, keeping time very, very strictly, so I may interrupt you. But let me quickly introduce our speakers and then maybe give you the context. We have Mr. Athanasios Orphanides with us from MIT, who also used to be the governor of the Central Bank of Cyprus. We have with us Professor John Danielsson, who is at LSE, who is heading the Systemic Risk Center. We have Mr. Federico Sturzenegger, who is currently at the University of St. Andrés, also at the Harvard, and used to be governor of the Central Bank of Argentina. We have with us Mr. Olivier Garnier, who is the Director General of Economics and International at the Banque de France. And we have with us online, you can see on screen, Ms. Sayuri Shirai, who is currently at ADBI. So you can see we have a very good lineup, and they're perfectly positioned to talk about all the aspects on policy that we touched upon. I think the key thing that the key question and the context that I want to focus our speakers today is, since COVID, we had so many changes. Everybody is talking about uncertainty. Everybody is talking about structural changes going forward. But a simple question is, so after all that spiel, so what have we learned? What is really new that we really learned from policy, monetary policy, fiscal policy going forward? And let me first give the floor to Mr. Orphanides. What's your take on this?
Thank you. Will we have an opportunity to share the slides?
Can we please put the slides on?
Because if I could take a few minutes for introductory remarks, this would set the stage. But I'm sorry, and I know that you are really strict on time, but I have to start by noting what a pleasure it is for me to be here, and what an honor it is to be invited. And when I hear the IMF reiterating the success of monetary and fiscal policy in the country, and congratulating authorities, the central bank and the government, for working very well together, I have to second that. Sometimes we need to listen to the IMF very carefully. When it comes to giving congratulations, well-deserved congratulations, we really should pay attention. So I wanted to start with that. And of course, the issue is not to give congratulations for the stability that we have seen in the country as a part of reflecting on the past, but in order to draw lessons about what has worked so that we can continue with good policies going forward. And this is how I will address the question that Armen posed on us. The last few years, as the governor pointed in his introductions, have been a particularly challenging period for central banks. And not all central banks have managed this period well. I'm quite a bit disappointed, being a former Fed person, that some of the largest central banks, including the Federal Reserve, messed up, which is after a few decades of considerably better monetary policy. I did not expect falling back to basic mistakes. And it's interesting to simply focus on the basics when we look at how things are handled. I'm going to use a couple more minutes to talk about the success of the Central Bank of Armenia by comparing Armenia with the euro area in this panel, Now, Central Bank of Armenia faces a much more challenging problem of maintaining price stability, which it has been doing admirably well. There is greater volatility in inflation in this country. It's a small open economy. The governor gave us a number of reasons. Even simple items like the increased importance of food in the weight in the CPI relative to, say, the euro area, and the volatility of food is something that is evident in the chart. But I want you to compare the experience in the last few years. If you look at the last few years that have been particularly challenging, there is nothing unusual in the inflation control in Armenia, as you can see on the left side panel. If you compare this with the right-hand side panel on the ECB, there is something clearly wrong. Again, I already mentioned the Fed. I'm not going to mention the Fed again. Let's just compare. Central banks are closer by here. The ECB is closer by. It's quite disturbing, if you look at this chart, to notice that the success of the ECB in controlling inflation over the last 20 plus years seems to be deteriorating over time. The ECB was quite successful when it was founded. It faced some challenges with the global financial crisis and later on, and really things fell apart with the pandemic and the experience of policy after the pandemic. And I want to focus a little bit on the last few years to highlight how important it is to not lose sight of the basics. So what I have in this chart is the inflation performance in Armenia and the euro area in the last few years. The dashed lines show the baseline projections for inflation that, in light of the transmission lags in monetary policy, should be an important guide in setting policy. I have with vertical black dashed lines noted the COVID easing in the first quarter of 2020. That was common. Central Bank of Armenia is policy, the ECB is policy. Virtually every central bank on the planet absolutely correctly is policy back then. But then I want to highlight this, what happened later on. And later on we see that in the case of Armenia, watching the evolution of inflation, the central bank correctly started adjusting policy towards a tighter direction already at the end of 2020, simply observing the fact that the recovery came much faster than what we expected overall. Some inflation risks started to materialize. Correctly, the Central Bank of Armenia was one of the very first central banks to actually start tightening policy after the pandemic. And I want you to compare this with the behavior of the ECB. On the right-hand side panel, liftoff for the ECB was delayed all the way to July 2022. And it's quite obvious here by looking at for the projections of inflation that the ECB has and the actual inflation of the ECB, the blue line. Already during 2021, there were red flags everywhere, and unfortunately, the central bank did not act appropriately. So what is going on here? And how did the ECB fall so badly behind the curve? What are the lessons we can draw for the present? Well, it's really basic. So one way to look at this is by looking at 2 year ahead inflation expectations, 2 year ahead policy. We need to be forward-looking because of the transmission lags in monetary policy. On the left-hand side panel here, I compare 2 year ahead inflation expectations based on swap markets. We have them for the euro area. We do not have them for all central banks, but they're actually quite reliable in that case. And I want you to see inflation expectations kept deteriorating, really starting in 2020. By 2021, it was very clear that policy needed to be adjusted, yet all the way to July of 2022, the ECB maintained negative interest rates, not just low rates, negative interest rates. I want you to see on the right-hand side, the policy communication was such that not only overnight interest rates, the orange line on the right-hand side, were kept negative. The communication for policy was that the ECB, no matter what was happening to inflation, was committed to stick to very accommodative policy, which you can see here in the blue line on the right-hand side shows the 2-year OIS curve, which is the 2-year expectation of policy rates. So in what sense was this losing track of the basics? Well, just put together a depiction of the real interest rate, what every student of economics knows really matters in economics, with inflation. And what we see in this chart is that as inflation, the black line, and inflation expectations reflected here in the black line were deteriorating, the policy of the ECB kept easing, kept pushing the real interest rate further and further down, which is really a very, very elementary monetary policy error. It's no surprise that we ended up with double-digit inflation in the euro area. So let me just conclude by saying, when we're dealing with uncertainty, we need to be careful not to invoke uncertainty in order to forget the basics. Not to invoke uncertainty in order to say, oh, policy can be discretionary because there is uncertainty. We don't need to pay attention to the systematic nature of monetary policy that we have learned over time needs to be respected for success. Uncertainty is nothing new. As I highlight here in the quote, Alan Greenspan in 2003 highlighted that it's not just a feature, it's the defining characteristic of the monetary policy landscape. We should not be using uncertainty as an excuse. And I want to close simply by reminding us all what the role of the central bank is. Do not lose sight of price stability. Do not make excuses, as some central banks have been doing in the last couple of years. And as, again, I see Central Bank of Armenia deserving a lot of praise for not falling for that. Do not lose sight of inflation. And it's worthwhile from time to time to go back and remind ourselves what Paul Volcker learned from the experience of the terrible days of the 70s and 80s that he had to deal with, and for us and for the central banking community to not forget these basics. That's my introduction.
Thanks very much. Maybe I'll just follow up on one of the points, because we know very well your work on uncertainty and how do you, we know that the importance of discretion versus more of a systematic policy, how much you have worked on it. Maybe you can, I take your main point is that, yes, there was a significant uncertainty. Yes, there was under big stress, the world was under big stress, but the basic principles of monetary policy held. But in some sense, maybe taking the Fed example, we cannot really, it's easier to talk about this like after 3 years, but when I remember 2020, at that point of time in real time, it's really difficult. Maybe you can, sort of follow up on that issue of uncertainty in real time.
Yeah, so
how should central banks cope with it?
So again, let me say a couple of words on this. And first of all, fully agree with you. As I highlighted before, virtually all central banks eased policy in 2020. For the major central banks, the Fed, the ECB, the BOJ did more easing in 3 months than they had ever done in their period. For the Fed, it was remarkable. The Fed did as much money printing in 3 months as it had done in 100 years in its history. And I praise central banks for doing this. This was the appropriate response. Why? Because there were threats for a catastrophic decline of the economy and threats of deflation. So really the basics are that once the situation turned, and before the end of 2020 already there were signs that the recovery was coming faster than we had, and we also had in many countries, not in all, a massive fiscal expansion that could also help us understand that there was an inflationary impetus. Policy needed to start being adjusted. So in real time, during 2021, the timing varies. In my case, I started highlighting that monetary policy needed to be adjusted in the second half of 2021. Others started doing it in the first half of 2021. By the end of 2021, there was no dispute that policy by central banks like the Federal Reserve and the ECB needed to be adjusted. So this is what I'm saying. How can you wait in the case of the ECB until July of 2022? 10% inflation. And then say, oh yeah, maybe we need to do something. I mean, you cannot call on uncertainty to give you an excuse for as basic and blunder as this.
That was very, very clear, I should say. Okay, maybe we can go next to Olivier. I think so we have at least 2 times heard the Jackson Hole speech of Christine Lagarde, where basically Christine Lagarde laid out in a structural way that the world is going to be different in the next 20 years. And there are lots of things which are going to change structurally. Climate, the supply chains, globalization. So for central bankers, structural change is fundamentally a nightmare because there are things that central banks cannot deal. It's very hard to deal. So how would be your answer to that question? How should monetary policy deal with this structural change, these big changes which are coming to the world in a real time? But I think your mic is not on. Can you hear?
It's supposed to be. Oh, no, it's okay.
Yeah, okay, sorry.
So, Mr. President, ladies and gentlemen, let me first say that it's a great privilege for me to participate to this symposium. You know the link between my country, France, and Armenia, and so that's why I'm very proud to be here. So now coming back to your question, and I think I have also, if you can show the slides. Coming back to your question, I think for sure the immediate question for the ECB, which was initially discussed by Athanasios, is the fight against inflation. But a key issue also is whether or not for the rest of this decade we are entering a new inflation regime after a period, as you know, during the past 3 decades we had the Great Moderation and then what I call the lowflation period after the great financial crisis. So if I can we see the slides? And for the sake of simplicity, I will try to make a distinction between the regimes based on key drivers for inflation regimes. First, the frequency and size of shocks. Second, global supply conditions. Third, global demand conditions. And last but not least, the macroeconomic policy framework. So we cannot still see, starting from the frequency and size of shocks, the first driver. Of course, this factor is closely related to the geopolitical context. It is no by hazard, if you remember, that the Great Moderation and the belief at that time in the end of the business cycle, or even some people were talking about the end of inflation, just followed the fall of the Berlin Wall and the claim that the end of history, as Fukuyama said, has arrived. So, on the first, so you see the first line where I put when there is a plus, that means it's a plus in terms of inflation risk and minus in terms of less inflation risk. And as we know now with the war in Ukraine and US-China tensions, there is little doubt that we are re-entering an era more subject to geopolitical shocks. In addition, climate change will increase the recurrence and the severity of natural disasters with implications in terms of economic disruption. So the first driver clearly will result in more frequent and larger shocks on prices. Second driver, global supply conditions. In relation with the geopolitical context and globalization forces, supply conditions will turn likely less friendly than during the past 3 decades. What we have to keep in mind is that during the past 3 decades, if global conditions were friendly, it was not directly because there were an acceleration in technical progress, what economists call, total factor productivity or higher potential growth. Indeed, it was rather the opposite in some advanced economy. But it was because global supply became much more flexible and more elastic, therefore dampening the effect of demand shocks. And now, moreover, with climate transition will likely have adverse effects, at least during the transition period, on global supply, resulting into large shocks and on relative prices. We know, for instance, for some energy and some minerals and metals will become scarcer and therefore more expensive during the transition. And part of the capital stock also may become obsolete or stranded, requiring large-scale sector relocation. There is one unknown. Could the digital transformation and artificial intelligence at last produce the long-term boost to TFP? But so far, there is no evidence. So turning now to the third factor, global demand condition, and this is the factor where I do not maybe expect a major change, and I keep on this factor the minus sign. The secular trends, including demographics, which have given rise to the so-called global savings glut or the safe asset shortage, are unlikely to revert quickly in the foreseeable future, and in particular, in a more fragmented and in a more volatile world, precautionary savings and self-insurance will continue to prevail, both at the domestic and at the global levels. Again, there is one unknown. We cannot rule out a surge in capital spending related to the climate transition. However, at least part of it could be a substitute rather than an addition to other investment. And if this capital spending surge, if it happens, it may, however, exacerbate sectoral imbalances. Last but not least, so I turn to my last driver, macroeconomic policy frameworks, because we all know as central bankers that inflation is ultimately a monetary phenomenon. And since the 90s, central bank independence combined with inflation targeting has proved key to anchor inflation expectations and achieve low and stable inflation over the medium term. At least also initially, fiscal policy frameworks designed to ensure long-term debt sustainability have also facilitated the conduct of monetary policy. If those two pillars, independence and credible inflation objective, were endangered, then in this new regime, there would be a risk of a higher inflation, a regime of durably higher inflation. If not, and this is my view, the new regime would not be one of higher inflation, but maybe more volatile inflation, not durably higher inflation, but more volatility. In other words, in this regime of greater volatility, central banks will still be able to meet their inflation objectives. Also, from time to time, it may require more forceful and delicate actions than in the era of great moderations. So that means that maybe the job of the central bank will be more difficult, but that doesn't mean that we will not be able to meet our target. And I will conclude with this. This is why, in my view, it is all the more important for central banks first, and maybe we will get back to this point, to bring back inflation to 2%, to the 2% objective, and then to keep unchanged this 2% inflation objective, which serves as a common nominal anchor. All the major central banks have the same inflation target of 2%, contrary to the recommendation to raise it advocated by some economists. And I will conclude by a quote by Christine Lagarde at the Jackson Hole Symposium. Christine said, "Faced with a changing world, monetary policy should not itself become a source of uncertainty." Thank you.
Very good. That was also Very clear. Let me go next to Federico. So Federico, when we talk about uncertainty, you really know what policy making in uncertainty means, given you were the governor of the Bank of Argentina, and you have a very big experience both in policy and academia. And I think basically I want to push you back a bit to the same question I asked to the other panelists and Professor Orphanides. What's new? Because so far I have been hearing that basically, yes, uncertainty is there. It's going to be much more challenging, but the fundamental principles hold. So what's your take on it?
Now?
Yep.
Yeah, there we go. Okay. So I also have to start by saying how much of a pleasure it is to be here. But I want to suggest a change to the title of the conference. I want to add one letter. One letter, because I think it should not be, or it could also be, 30 years of the Armenian dram, or maybe it's the 30 years of the Armenian dream. So we add the E, okay, there. And I think coming from Argentina, which is a country which for the last 15 years has not grown, it certainly looks that way, and listening to the opening speech, I'm glad that it's perceived that way here, and I think it should be. So, and certainly those are two things which are related, because if you don't have a stable currency, an economy cannot dream. And I'm coming from an economy which has a 30% inflation rate right now, and it's an economy which feels it's kind of falling apart. So I think these two things are very related. And this has to do with the topic that I'm going to talk about, which is what do we know about monetary policy, how to think about monetary policy, what can a central bank do? This is joint work that I've just finished with a colleague of mine at Universidad San Andrés, Javier Garcia Chico, and Patricio Goldstein from Columbia University, okay? So I'm going to be asking about monetary policy. What can monetary policy do? And I think this relates to two concepts that we discuss in the literature, which are monetary policy neutrality and monetary policy super neutrality. What are these two things? Well, neutrality means that in the long run, money cannot affect output. And super neutrality means that what happens to output does not depend on the inflation rate. So the inflation rate also has no effect on the output, and this I would say are the main tenets of basic macroeconomic models, okay? Now, if you think about this second issue, which is super neutrality, whether the inflation rate matters or not, well, I mean, people are discussing the inflation target in the US. Last week we had a discussion between Paul Krugman and Larry Summers, whether the Fed should go back to 2%, should stay at 3%. So that means they don't think the level of the inflation rate is irrelevant. And if you think of a country like mine, which has such high inflation rate, I tell you, the inflation rate is totally irrelevant, because if you have an inflation rate which is more than 10, 20, or 30%, that has a devastating effect on the economy. So when you're a practitioner, you realize that maybe the inflation rate does matter a lot, not as in our theoretical models where supposedly it doesn't matter. So I want to talk about this issue. And I want to base myself on a paper which was very recently published in the American Economic Review by Martin Uribe. And he says to understand monetary policy, we have to disentangle monetary policy in two types of shocks. Transitory shocks, like for example, you tighten monetary policy to bring down inflation, but the overall inflation target is the same. And permanent monetary shocks, which are those aiming to change the long-run inflation rate. Permanent monetary shocks, transitory monetary shocks. And he says these two shocks work in a very different way. Like, for example, if you look at this slide here, let me see if I can show it here with my pointer here to your right. If you look at, let's say, look at the right column first, that would be a transitory monetary tightening. In the lower graph, you see that output declines, the real interest rate goes up because interest rates go up and inflation comes down. On the left-hand side, you have a permanent monetary shock. So this is a shock that attempts to increase the inflation rate in the long run, and you can see the blue line that inflation increases, the interest rates also increase, and output increases. So in the path, output increases. So this is Uribe, and he does this for the US with some complicated econometric techniques that we won't discuss here. So our objective here was twofold. First, we wanted to see if this decomposition holds for other countries. And how does it hold, say, for higher inflation countries? And the second thing is that when Uribe makes these estimations, he assumes super neutrality. So he assumes that these permanent monetary shocks don't have an effect on the economy. And I want to get rid of that assumption because I want to see if effectively changing the inflation rate has an effect, okay? So this is how Uribe discusses why permanent monetary shocks and transitory monetary shocks work differently. This resembles the graph that Athanasios just showed. If you have a transitory monetary shock, the real interest rate increases. If you have a permanent monetary shock, the real interest rate in the short run decreases. Okay, and this is the reason it's different. So I'm going to show you now this graph that I don't pretend you to just so that you know that I've done it. Okay, so we've done the estimation for other countries. If you look here in the bottom right corner, you see USA. Okay, so that you see that that's kind of the same result that Uribe has. If you have the European Union there in the middle of the second row, it looks very much like the US. But I want to focus on this table, which somehow summarizes what I'm trying to say, which is the following. If you look, so the fourth column with numbers there basically tells you what's the effect on output over the whole transition when you try to increase the inflation rates 1%. So remember, Uribe is saying if you have a permanent shock that increases the inflation rate, you're not going to affect output in the long run, but in the transition you may have a positive effect. But you see that for the US, that effect is relatively significant, so it is for Europe. But once you get away from Europe and the US, the effect is minimal. So that means that the effect of monetary policy on output in the rest of the world is much more muted, okay? And this applies both to increasing the inflation rate and decreasing the inflation rate. So I want to focus more on the decreasing the inflation rates. Sometimes people, oh, it's costly from an output point of view to decrease the inflation rate. It's not costly, okay? So that would be my first conclusion. This is the effect of a transitory monetary shock. You see that it operates as in the US with a negative effect at monetary tightening, but again, with a strong output effect in the US and Europe, but much less in the rest of the world. So this is one of the first distinctions I wanted to make. Now, having said that, I want to show you this graph. This graph basically shows you think of this as you're trying to change the inflation target upwards, 1%. What's the effect, the cumulative effect on output? And what do you see here? You see a negative line, correct? You see two things. First, it's a negative line. So that means that if your inflation rate is, say, somewhat above 4%, trying to push for a higher inflation rate is going to decrease output, not increase output. So you don't want to do that. And the other thing is, if you look at the axis, you see the vertical axis here is 0.5. So with a few exceptions, basically you're not going to get anything in terms of output out of that. Okay? So I think this is a strong predicament for central banks really focusing on the issue of price stability and focusing on price stability with a low inflation target, as most countries in the world do, and that really there's not much to be gained from asking something else from the central bank. Let me just remember that I'm 5-6 minutes, so remember I said that this estimation had this assumption that the long-term permanent shocks did not affect output. So now let's remove that assumption. And you see here, for example, when I remove the assumption that the graph for the US is the same, but it's not the same for Europe. In the Europe, you see that the output increases and remains a little bit there. So here it's basically without the assumption of this super neutrality. And notice that there Europe appears a little bit of an outlier. In the rest of the countries of the world, there's very little to be had from actually trying to have a higher inflation rate in terms of output, let's say. And so let me finish with this graph, which is similar to the one that I showed you before, and which basically is what is the effect of increasing the inflation target and how it relates to the average inflation, which is what I have in the horizontal axis. And again, what this is saying is that if your inflation rate is somewhat above 4%, there's nothing that you have to gain from trying to push for a higher inflation, and there's very little to lose from trying to bring down the inflation as well, okay? So I remember we were discussing these results, and my co-author says, well, but this is kind of very conventional, because what is this saying at the end of the day? This is saying that central banks should focus on price stability because they can't do much in terms of output. In fact, if you overdo it, you're going to have a negative effect on output. And that's really what central banks really do. And I say there's no problem with being conventional. So if we look at the data from a different angle, and it basically validates what central banks have been doing.
Perfect. Thanks very much. That was also very loud and clear. Quick follow-up. Given you talked about basically the same principles as back to basics, so to speak.
Yes.
Are you willing to speculate what's going to happen in the U.S. in terms of the interest rates, making it more
I'm
practical?
always happy. Look, I'm from Argentina, so I can give an opinion on everything. Okay, so happy to give an opinion on that. When a central bank fixes the interest rate, the money supply becomes endogenous. It's endogenous, okay? So you shouldn't kind of make too much out of looking at monetary aggregates. But I want to point out one, I would say, stark fact from the US monetary situation, which is the following. If we ask ourselves, how much more money is there in the US, M2, relative to pre-COVID? That number is about 50%. So in the US, there's 50% more money. Okay, maybe it's endogenous. Maybe people are demanding that. We had 50% more money, so the money supply has expanded 50%. So far, inflation has been 15%. And you have to push me a lot for me to say that you have a 25% increase in the demand for money. Maybe. My conclusion from that, I think that there's still a lot of inflation coming in the U.S. from this big monetary expansion. So I think, of course, the last few numbers of inflation in the U.S. have been very, very, very good, much better than I would have expected. But I would be skeptical. I would very much keep myself, on the guard, because I think there's still a lot of excess money in the system, and I think the Fed is going to take that cautious approach, and that means that I think that the coming down of interest rate is going to take a while to materialize.
Okay, very good. Let me maybe, I see that
Athanasios
want to disagree with you.
Yeah.
And this is a too friendly of a panel, so I'm hoping for some controversy.
Yes, Federico, you caused me to intervene here because you reminded me that I started my career at the Fed focusing on M2 and estimating demand functions and projecting and looking at the instability and so forth. And I wanted to make one comment on that and then go back to the policy issue that you raised. So on M2, we can explain most of the increase in M2 as a result of the way in which fiscal expansion was implemented in the United States. Unlike work that many of us, including me, were doing 30 years ago, saying that would have been inflationary, in this particular episode, we had a very good explanation. So the inflation we ended up seeing nothing to do with M2 growth. M2 growth was explained, and M2 growth actually has already reversed. So we see that the surprise increase in M2 is dissipating already, and is projected to normalize. So I wouldn't worry that much about the monetary aggregates in the United States. You are giving me also the opportunity to say that I was critical of the Fed in passing. They should have started adjusting policy in 2021, and they did not. But I do give credit to the Fed that once they realized that they fell behind,
they went faster.
They actually started acting much faster than other central banks who had also realized that they fell behind. And the fact that they were doing repeated 75 basis points increases brought them very close to where they need to be. So right now, I don't think they are where they need to be, simply because the economy is still stronger than they expected it to be. Had the economy slowed down in the last 3 months according to the baseline scenario that the FOMC was outlining, I think they would be done. But because the economy has not slowed down sufficiently, and the evidence on sticky inflation is that it's going to take a while longer to come down, it would be advisable to take some insurance in the form of another 1 or 2 25 basis points moves.
Thanks very much. Let me now switch gears a bit, because so far we have been talking about the uncertainty. I've been talking about how the monetary policy, fiscal policy react to the shocks. But one of the key points of debate recently is, okay, what's going to happen in the long run? So what is the long run interest rates going to be going forward? Are we going to see the decrease of long interest rates that we have seen last 20 years? Or there is something fundamentally different? For example, the shocks, the uncertainty that's going to limit the ability of central banks to decrease the rates because the long run interest rates are going to be higher. So on top of it, I also want to add that one of the key uncertainties is really, centered around what's going to happen in China. So that's why I think Ms. Shirai is perfectly placed to give us the view on, first, what's your view on the perspective of long-run interest rates? And what is basically the key topic of conversation in Asia now? How do you view this from that angle? Please, floor is yours.
Yes.
And can we put the slides on for Ms. Shirai?
Yes. So I'm participating from Tokyo, and I hope you can see it.
We can see you and we can hear you very well.
Okay, so before I start presentation, let me point out 2 things. So I worked for the Bank of Japan as a policy board members. So let me explain what's happening to Bank of Japan right now. So in Japan, inflation is 3%, so well above 2% price stability target. But Bank of Japan is one of the few central banks in the world that still maintain monetary easing. So in another word, Bank of Japan maintain yield curve control, which means maintaining negative minus 0.1% on short end of yield curve, and also stabilizing 10-year yield at 0% with some fluctuation band. The other point is that when in Asia, when we talk about geopolitical risk, as Armen said, it's all about China. There's a growing tension in Asia. Okay, so today I'd like to talk about this interest rate issues. So if we look at over 3 decades, so we enjoyed this long-term, both real and nominal interest rate drop. There are so many the literatures which talk about factors contributing to declining yield. So why is it? Because of the declining natural rate of interest. And the second reason is, as discussed today in the presentation, it's partly because of the stabilizing inflation expectation due to the inflation targeting adopted by many countries. And also it's related to declining term premium, partly because of financial regulation, the demand for safety, that also contributed to the lower yield. So this is an estimate made by IMF. So it's one is the US and another one is Japan. So what is clear from this chart with regards to natural rate of interest rate, so over this period, we all saw this decline in natural rate. So one of the reasons why we saw these common factors, which is declining natural rate, is because of the decline in potential growth rates. And it's partly, mainly because of demographics, we all having aging, and also partly because of limited productivity growth. And also all advanced countries shifted to the services sector. So that contributed to potential growth rate and therefore decline in natural rate of interest. Now, on the other hand, when we look at the fiscal deficit and rising and debt issues, over this period, all these advanced economies face this fiscal deficit deterioration and growing debt. However, the long-term yield remain quite low, partly because, please look at left and bottom, partly because there was a growing demand for safety asset, and partly it was contributed by growing saving coming from China. Okay. So this is the public debt as a percent of GDP. One is Japan. You may be surprised to see Japan's public debt is 260%. One is one of the biggest debt in the world, but there is no sign of debt crisis at this stage. And also, U.S. debt is also growing to nearly 140%. So over this 2 to 3 decades, we all experienced this deterioration of fiscal deficit, but yet we saw a decline in natural rate. So IMF made a very interesting chart, and then they did an empirical analysis and analyzed the what factors contributed to this decline in natural rate between 1975-79 and 2015 and 19. So let's look at Japan. Please see a red dotted area. So over this period, Japan's nominal interest rate remained nearly stable, even though we experienced this fiscal deficit deterioration and debt, but the natural rate remained low, mainly because we had a demographic aging, so people worked longer and people save more. So that contributed to the low natural rate. Let's look at the United States in the middle. Look at the blue dotted line. So US, over this period, the natural rate of interest dropped, and their demographics is not as serious as Japan or as a European country. So the major contributors to the decline in natural rate came from this TFP growth stagnancy. Okay, so let's go back to Japan's issue. Over this period, we saw the saving dropping, investment dropping, but in the past 10 years, we saw some decline, increase in saving, and this partly because of increasing corporate savings. The Japanese corporate sectors has tons of saving, and they haven't spent a lot of money for capital spending, so that contributed to the sort of a low level of natural rate. So this is a number of working people. We have a declining population. We have a declining working age population since 1990s, but because of aging, people work longer, so we didn't see a decline in actual number of working employees. So that contributed to some extent the household saving together with corporate sector saving. Now, globally, we have a lot of discussion about what will happen to this direction of natural rate. So led by Professor Summers, they say in the future, the natural rate will go up. The main reason is that, including Japan, the people worked longer and people saved a lot, but they are about to exit from labor market, so they will start to consume. And also, we now have to invest more on green investment. And because of this geopolitical risk, we are increasing military spending. And then we have a labor shortage, so that will lead to the higher wages. So it means inequality will be lower. So it means it increased the consumption propensity. So more consumption is a lower saving. So that is an argument made by Professor Summers and some others. On the other hand, IMF, Blanchard, Obsfeld, they say the natural rate of interest will remain low, mainly because globally, even emerging economies, they face aging, so they have to work longer, so they will save. So global saving will continue to go up. Now, it's true the green investment will go up, but that will be offset by declining brown investment. Another point they made is that even though government spending may go up, but their spending may be constrained by credit rating and debt sustainability issue. So there is a lot of discussion, but let me check in the case of Japan. Remember at the beginning, I talked about Banque of Japan's policy, so they maintain yield curve control, so negative minus 0.1% on short-term interest rate, and then stabilizing 10-year yield at 0% with some fluctuation band. Very unique policy in the world. Now, a lot of market participants think the side effect of this yield curve control was the distortion created severely in the bond market. There is a little liquidity in the bond market, so market participants now expect the flexibility should be introduced. More normalization should take place by Bank of Japan under new governors. He started, we have a new governor from April. And on the other hand, government increasing debt. So far, we still have a credit rating with single A stable. But what will happen if the Bank of Japan starts to normalize the YCC, interest rate will start to go up. On the other hand, government spending, going up. So this government debt issue might lead to the higher rate of natural rate. Finally, also, if we look at household saving, corporate saving, we have so many aging workers, so they are about to retire. Everybody's in the 70 years old, so we will start to see a consumption saving, and corporate sectors are having a difficulty to maintain profitability, so they may not be able to maintain corporate saving in the future. So in the future, I think the natural rate of interest will start to go up, also in Japan, gradually over this period, mainly because of this consumption of saving will happen. So to conclude, I think in a nominal yield, in many countries, I think in Japan particularly, but also US, unlikely to go back to the pre-COVID period. And in the case of Japan, right now, 10-year yield is just 0.6%, but it's likely to see an increase in 10-year yield over time. This is because rapid pace of aging, creating labor shortage, and so that will lead to the higher nominal wage, and the intensified geopolitical risk happening from China. And so we try to diversify production from China. We all depend too much on China, but which means it's more costly to produce in other countries, in United States, Japan. So that will lead to the higher production cost and inflation. We have a huge debt and still growing, and partly because of greater military spending and also investment. So that will also lead to the higher natural rate of interest, the saving, and finally Bank of Japan's normalization. So I think at least clearly in Japan, we have to prepare for higher nominal interest and higher real interest. Thank you very much.
Very much. I think this is also a very important note that in fact, there is actually a very big risk that long-run rates may not go down, and this is going to be a big problem. Now, John, it's your turn. We have been talking about monetary policy so far, and the important things after the global financial crisis is really, can we separate monetary policy and financial stability? Everybody I talk to, everybody I ask to, they say yes. It's clear. I asked this question to Governor of Bank of England, Andrew Bailey. He said, yes, we should separate it. I asked this question at the Financial Stability Board. Everybody says, yes, we should separate it. But my question is, and we saw that in the US, we saw two banks went under the water because of the increase of the interest rates very quickly. We saw Credit Suisse going under the water. So my question to you is this separation just a wishful thinking or reality? What's your take on it?
It's wishful thinking. Do you need any more? Okay.
Maybe elaborate a bit.
Elaborate a bit, yeah. So I've been coming to central bank conferences for a long time. I remember 20 years ago when we had very important people saying, we have to separate financial stability from monetary policy. Central banks should only do monetary. 2009, another conference, equally VIP-ness. All the important people said, well, yes, we had the crisis in 2009, but we have macroprudential policy. That allows us to do what we want on the monetary side, and we let the macro-pru guys clean up after us. And I think that's just wrong. And Anastasia came into the topic a little bit. I want to mention 3 channels. Has anybody thought about what happens when you do QE mechanically? So this is both Europe and the US. Okay, so mechanically this is what happens. A pension fund sells a bond to a bank. The bank sells a bond to the central bank, which then increases the reserve account of the commercial bank. What does the pension fund do with the money? In the US, they left it as a demand deposit account. So therefore, M1 goes sharply up, reserve accounts go up. What happens to the velocity of money? Goes down. If you want an explanation for why QE didn't cause inflation, that is the explanation. Now here's the problem for the monetary authority in this. It turns out it is super easy to increase leverage in the financial system. It is not easy to decrease it. When the Fed tries to unwind this in November 2029, the bank screamed and said, "You'll cause a crisis." As it turned out, easy to do QE, QT is a crisis-inducing action. That is the first problem. The same applies to Europe. So this also explains if the money is just sitting in a demand deposit account, it is not doing what the macroeconomy is saying, stimulating the economy. It is just two accounts went up along with leverage. And I think this is one reason why it is very important for the monetary authority to think about how monetary policy is actually implemented. Secondly, who buys government bonds? Well, the government bonds are bought by commercial banks, not in the US, but in Europe. Over 20% of government bonds are owned by commercial banks. We saw with Credit Suisse, we saw with the Silicon Valley Bank, you increase interest rates and boom, the bank is bust. Why is that? Because it followed best advice and bought government bonds that then fell in price when you try to do monetary tightening. Well, not all that good in Europe. They tell us this will not happen because, well, we are hedging. Now, as a finance professor, I say, why are you buying a government bond if you then hedge it? Right? It doesn't make any sense as a transaction. I suspect what is happening is there's a huge number of submarine problems hiding in the balance sheet of European banks that will emerge as the ECB continues to tighten. And the third channel for why this is important is simply real estate. We know the single biggest cause of crisis in the world is real estate. The single biggest. And it's sort of mechanics 101. You make money cheap, you increase demand for speculative assets, increasing real estate, you leverage the households up to the hilt. When you tighten, all of a sudden you start seeing households defaulting. And guess who gets blamed for that? The central bank. Right. So it becomes very difficult to unwind an accumulative monetary policy. These are three financial market effects that cause problems. So if you think about the objectives of government policy towards financial markets, and I wrote a paper on this with Charles Goodhart, there are three. Number one, and most important, is economic growth. I know this might be a dirty word in some circles, but without growth, we don't need anything else. So it has to be number one. Price stability and financial stability. So to ask your question, there is no conflict. Well, that is, of course, if you live in best of all possible world, but Candide was a piece of literature, a satire of Voltaire. We do not live in the best of all possible world. Shocks happen. Russia invades Ukraine, US decides to have conflict with China, or COVID happens, something happens. This is the uncertainty bit. I'm slightly allergic to the uncertainty in the policy process, but this is uncertainty coming from the outside. And the problem is these objectives are generally in conflict. We call it a trilemma, but that's an overused word, so we try not to say too much along those lines. But let's just go through the really quick mechanics here. You have high inflation, you raise interest rates. You raise interest rates, you make money more expensive, the economy contracts, as supposed to happen. But if in Europe at the moment, where the economy is already contracting, well, that's not a nice thing to do, is to tighten in a recessionary environment. That leads to a stagflation environment. Secondly, it also causes problems for the bank's balance sheets, which then lead to tightening of lending into the real economy, which is also recessionary. Okay, you have financial stability, and then you say macro-pru. Macro-pru is all about capital. You increase capital levels, well, who pays for that? It's the cost of lending, because it immediately hits the bank's lending costs. And now let me connect this to politics. What is the marginal loan a bank decides not to make? The marginal loan goes to probably the poorest household in the most deprived region of your country. Who are they likely to go screaming to? The extremist populist parties blaming the central bank. So therefore, when you increase capital, it does not have an even distributional effect on the economy. It is a very sharp marginal effect on particular types of citizens living in a particular type of constituency, yet feeding onto populism. So this is one reason why I think at the moment we are dealing with the aftermath of quantitative tightening, but the quantitative easing at the time should also have considered this effect. And maybe if they had done so, they would have realized that there might be higher costs down the road. And can macro-pro as a policy domain deal with this? And my contention is not really. So basic economics, for those of you who are economists, what macro-pro and regulation policy does, it does two things. It harmonizes beliefs, makes everybody see the world in the same way. And it harmonizes action. You have to react to shocks in the same way. Now you ask an undergraduate economist what that causes. Booms and busts. Because you feed on yourself on the way up and you feed on yourself on the way down. So therefore, trying to solve this problem with macro-pro increases systemic risk. In other words, to use the language of finance, we lower volatility, day-to-day fluctuations at the expense of the fat tails, which is the big busts and booms at the end. So therefore, that is sort of my take on why I think the monetary policymakers might want to consider the financial system and what they're doing.
That was very provocative. And Federico, do you want to react? Because I see.
Is this working?
Yeah.
I think now it's working. No, I wanted to complement what was just said by looking at a different asset class, which is emerging market debt. And 2 years ago, when the interest rates in the US started going up, or what was it, a year and a half ago, or whatever, everybody said we're going to have a crisis in emerging market debt because, of course, the money is going to flow back to the US and it's going to, and it didn't happen, no? And so let me pose a hypothesis why it didn't happen. And my hypothesis is that, the US has had like 40 years without inflation. So people they got use of issuing debt in dollars at fixed interest rate. In the 70s, when the US had a lot of inflation, it was variable rate. But now you issue at fixed rate. So why is the interest rate going up? Because the inflation rate in the US went up. Now, the inflation rate in the US going up is basically reducing the real value of that debt, which is fixed in dollars, in nominal terms. So you have a flow effect of money going out, but you have a stock effect. And I think that can be an explanation why this time the increase in the interest rate did not generate a generalized crisis in emerging market debt. I'm just mentioning it if that may be a channel which somehow reduces the negative impact of the hike in the interest rate in, say, in the context of the US and QT in general.
I completely agree with you. If I had more time, I would have mentioned that particular channel, because what we are seeing is the natural hedging between the value of bonds being eroded, value of liabilities being eroded, and the cost of refinancing going up. This is why pension funds are not affected by rising interest rates. They're naturally hedged, and so are insurance companies. But I just think you reinforce my point, which is that the monetary authority needs to consider how the money makes its way through the financial system.
Perfect. We have 2 minutes before I open to the questions, because I want to have 10 clear minutes for questions. You wanted to add something? Yep,
yes, thank you. I wanted to add a slightly different dimension to this, while fundamentally agreeing with what has just been said. Sometimes the question is posed slightly differently, is there a trade-off between monetary policy and financial stability? Or slightly even more differently, is there a trade-off in the long run between financial stability and price stability? And the answers are not exactly the same in the variation of these questions. Fundamentally, I think most of us would agree that in the long run, price stability is a precondition for financial stability. Financial stability supports price stability. There is no trade-off in the long run with reasonable policies. Now, the fundamental point that was made is that we are not in the long run and we have shocks all the time. So clearly, you need to be taking into account the interactions. Now, one way to think about it in the back to the basics element is that, well, how is monetary policy supposed to be designed? Taking into account the risks to the outlook, projections are being created, risk scenarios are being examined. If the financial system is weaker, growth projections will be lower, the deflationary risks will increase. So just by using the normal monetary policy process, of course, changes in financial stability and weakness in financial system will influence monetary policy. So it would be silly to deny that. That actually reminds me another link that we didn't get much time to discuss, but was mentioned by the governor in the introduction, very similar to fiscal policy. Of course, monetary policy has to take and does take into account fiscal policy. The projections of the fiscal outlook are always taken into account in a reasonably good monetary policy framework in calibrating today's monetary policy. So one cannot deny that there is some relation in when everyday monetary policy making is done.
Please,
Yeah.
Yep.
Yeah, just a remark, just to say that so far, if I take the example of Europe, the rise in interest rates has not hurt the banking sector in Europe. Quite the opposite, because interest rate margins have much increased in Europe, because the increase on the asset side of interest rates has been much quicker than on the liability side. So at some point of time, maybe you could see, especially if there were NPLs or what, but so far, there is not that much, a negative effect on the banking system of the tightening in monetary policy at this stage of the cycle.
Okay. I like that point, and the point is correct, but I have a big but, right? What this is saying is there are problems on the bank's asset side because of rising interest rates. So the banks are making it up by making people borrow more, they pay higher for making loans. And who is paying for that? That's a marginal borrower. That is the borrower that lives in the constituency that votes for Marine Le Pen in France.
I'm not sure that this is the case, because the marginal borrower, if I take the example of France, it's not the poor people are not the people who are borrowing for real estate. And in that case, fiscal policy for this kind of the population is much more important than monetary policy. There is a safety net. So I'm not sure that, maybe it's right in the UK, but I'm not sure that it's right in the rest of in Europe.
I think it's right in France. This has been extensively studied. Is how this is quite elementary, because what happens is the banks are making a loan. The first loan not to be made is a marginal loan. That's the highest risk borrower. That is a low-income person borrowing to buy a car or financing their small SME or something. And there's plenty of evidence to that effect.
And this is where my despotic nature comes in, and I stop this conversation because we are actually perfect on time. I have 10 minutes for questions. Okay. One administrative note. We are very interested in your opinions in general, but right now we're interested in your questions. So, question mark, short, concise. I'm going to collect 5 questions. Please introduce yourself and then answer. I have too many hands actually. Okay, Paul first, then gentleman in the back. Yeah, and then Vacek Apelen and 2 hands there. Okay, I'm done. Please.
Shall I stand up and make it easier for everyone?
Yeah.
First of all, maybe I have to talk like this.
But no, we need a mic. mic so that Ms. Shirai can...
No, for the recording, I think you need the mic.
We can use the podium. The important mic.
Okay, thank you very much. My name is Paul Hilbers. I'm the Executive Director representing 16 countries, including Armenia, in the board of the IMF. That's where I come from. I would like to compliment very briefly, of course, you very much on this conference and on 30 years of the DRAM. I was in Armenia in the 90s, and I know how it has changed. And I really want to congratulate you on your enormous economic performance over these 30 years, and also in recent years, I should say. And on monetary policy, I think the Central Bank of Armenia really got it right by raising interest rates at a very early stage. This is what I wanted to comment on. My question, Armen, very, very briefly. This has been going very much focusing on monetary policy, but the title is monetary and fiscal policy. So my very concise question to the participants in the panel is, how do you see the trade-off? How do you see the balance between monetary and fiscal policy here? And very concretely, is there not also a role for fiscal policy in managing the inflationary pressures of the moment? Thank you very much.
Yeah, question for the panel. Triggered by Olivier's remark, we may have a new regime of inflation. Maybe there's one element which... Jean-Pierre Landau, sorry. Maybe there's a new element that you should add to your consideration, the level of public debt in the world. Public debt has never been as high in percentage of GDP in peacetime in advanced economies. We have theories which tell us that it could trigger inflation. We have theory which tell us it will trigger inflation. So my question to the panel, how do you react in terms of monetary framework to that situation?
Yes, I'm going to repeat to somewhat Paul Hilbert's question. It is, I remember there was a debate in the 60s between Walter Heller and Milton Friedman. One was, is monetary policy being oversold? The other was, is fiscal policy being oversold? So my impression was that monetary policy is being oversold. Are there limits to monetary policy when you are buying any warm paper that you see on the Main Street and not even in the Wall Street, and you are expanding manifold the balance sheet, etc.? Is it because suddenly there was no room for fiscal maneuver? Are we in an age when we are going to be in the same case all the time, and fiscal is going to say there is no room and you are on your own? So how do you are going to deal with the volatility?
Very good. My mic doesn't work, but questions there.
Yeah. Thank you very much for a very insightful discussion and trying to bring that to some practical aspects. So as the IMF paper was shared with us to our attention, and interestingly came to some point which is like common for CCA countries. There is some disrupt between commercial banks based on some regulatory and institutional shortcomings. Banks prefer in some times to lend at lower rates to the central bank and not to interact with each other. Do you think what can a regulator done even better, and if yes, to what extent, to somehow to like increase market activity from this perspective?
Paola Subacchi, Queen Mary University of London. I'd like to pick up two things that Professor Orphanides mentioned of mistakes, central bank mistakes, and also Mr. Garnier, changing dynamics in inflation. One thing is missing in your slide is the 2008-2009 period, which is where we had the most non-conventional monetary policy, spillover effect from systemically important countries, impact on the many central bankers and and ministers from emerging market complain. Remember the currency war. forward guiding, which didn't work, and we had the tapering tantrum and so on. So my question to the panel is, how much the mistakes made after the COVID were somehow influenced by the different approach to monetary policy making than we saw in the previous 10 years? And then I have another question, if I may. Financial markets expectation got crazy in 2020. Valuation was absolutely over the roof. Everybody knew they were absolutely crazy, and obviously markets expectations were adjusting. But markets are still expecting quite loose monetary policy, and that's what is the current sentiment. So I know the central banks have price stability as an objective, but I wonder how much financial stability was in the back of their mind when they decided to go easy on monetary policy. Thank you.
Okay, thanks very much. So maybe I'll group the questions. So there's a big block of questions on fiscal policy. Basically, what's the role, what's the scope of fiscal policy? Does it have to be bigger going forward, given the nature of the structural shocks? What's the monetary policy and fiscal nexus? There's another question which was just, I'm not going to repeat it, but basically the key question is, are we seeing actually a response to financial stability rather than a monetary policy response? And that's basically masking all the underlying mess that we are in now, and how is this actually affected by the previous policy mistakes. Okay, so I'm gonna give the floor to Ms. Shirai first, and then we'll basically distribute the questions before here.
Yes. So I'd like to talk about the relationship between fiscal policy and monetary policy. So ECB, Federal Reserve, Bank of Japan did massive QE in the past. So when we conduct QE, mainly it means we purchase government bond. So there is a direct relationship, to be honest, between monetary policy and fiscal policy. So far, Federal Reserve reduced the balance sheet from 9 trillion US dollars to 8 trillion US dollars. That's all, right? So this, QT is not so massive yet. And so most of these government bonds are purchased by MMF, so they can handle it. But if they have to reduce balance sheet much more, then there might be some inconsistency between the government needs to increase spending and central banks withdrawal from a government bond market. And same in Japan. Bank of Japan hold 56% of Japanese of government bond. So if they will have to do QT, this will have a tremendous impact on the banking sector, financial system. So QT creates a lot of difficulty, not only for the fiscal policy, but also financial stability. Thank you.
Thanks very much. I think that point also was very close to what John was mentioning. Okay, who wants to take on further on the question on fiscal? Does fiscal policy have a role in price stability or no? Federico, you want to go?
Yeah, I can take a stab at it. Of course, my perspective is going to be from Argentina, so it's a relatively different environment, and I think monetary policy has a lot to do with credibility and conveying exactly what you want to do and what are your objectives. So in some countries, when you mix up monetary policy with fiscal policy, it's extremely difficult for the central bank to convey what they're going to do. What's their target going to be? What's their monetary policy going to be? Because now there's the dimensionality of the decision of monetary policy becomes much bigger, and it's much more difficult to build credibility. So again, I'm giving the perspective of a country which kind of is in the struggle to build credibility. So I tend to like the separation, but because of this perspective. The second thing which relates to fiscal is the debt question, which I think is interesting. And John Cochrane, he has a book, recent book, and he says something there which I think is perhaps kind of overlooked, but I think it's pretty deep. He says, when we think about how monetary policy works, we are assuming that fiscal policy will do what has to be done so that monetary policy has that. I'll give an example. You increase interest rates. Well, of course, the the interest payment on US debt, say for example, if we're talking of the US, goes up, correct? When the Fed increases the interest rate. So we are assuming that fiscal policy will do what it has to do, will increase taxes in a way to pay for the higher interest payment, okay? So there is implicit in our understanding of how monetary policy works, an implicit assumption that fiscal policy is going to accommodate, okay? And when you go to countries which have much higher debt ratios and much higher interest rates and real interest because of their instability, you see this tension appearing and that assumption kind of really being a problem. So I think that in countries with more volatility, this is an issue that has to be taken into account because I think it is a real source of instability. You can't go with that implicit assumption. And my last comment, maybe on the mistakes issue, no? And I'm going to insist a little bit with the monetary aggregates. And so if you go to 2008, 2009, you saw a huge expansion in the monetary base. But if you look at M2, nothing happened, zero. And it's a little bit because of the mechanism that was being described before. Now, after COVID, you had a similar expansion in the monetary base. Why did that happen in 2008? Because, of course, the money multiplier was collapsing because we were in the middle of a financial crisis, so it makes all the sense in the world. Now, if you do the same monetary expansion in 2020 without the same financial crisis, it kind of goes straight into M2, okay? Money base has come down. I think M2, I don't know if it started to come down. I don't think as much as monetary base. So I think that was a mistake, which is to thinking that that transmission thing was going to work in the same way. Of course, look, being governor, you know, with Monday's newspaper, it's always so easy to say, oh, you were mistaken, no? I mean, you have to put yourself in the situation where policymakers were at the moment of making the decisions. I tend to think that they were slow to react, but and I think there's persuasive evidence. When Jay Powell was saying, I'm going to be data dependent, he was saying, I'm always going to be behind the curve, by definition. Because he's saying, I'm not going to do anything until the inflation goes up, correct? So it's a definition that I'm going to be behind the curve and I'm going to be late. I think that's a mistake. I think that is something that was reversed and we saw it in the speed at which they adjusted. But I think the fundamental thing was thinking that in 2020, you could do the same thing that you had done in 2008, and it was going to work the same way when the environment was totally different. I would point out to that as a big thing.
Okay, Olivier, and then yeah, please. And then specifically, there was a is there a limit? Is there a limit to monetary policy? Is it the only game in town? Or fiscal as well. Please go ahead.
Maybe two remarks, one on fiscal policy and one on mistake, and maybe just on the question of course, monetary policy should not be the only game in town. But on fiscal policy, first to say that in the previous inflation regimes, you know, it was rather easy because, especially with the zero lower bound, fiscal policy and monetary policy were rather complementary, and there was no need to coordinate, but they had to push in the same direction, and it was even more the case at the beginning of the COVID crisis. Now it's much more difficult because, of course, when you face inflation risks, in that case, fiscal policy could be an obstacle to good monetary policy. So that's why I think, of course, from the standpoint of the central bank, we have to prevent fiscal dominance. And in the case of Europe, that means that's the reason why we have to introduce new rules. That doesn't mean that we have to get back to the previous fiscal rules, but we absolutely need a new fiscal framework. And on mistakes, I would say in the case of the exit of the COVID crisis, and you know, Athanasios made some comments on that, I think for sure we were somewhat at the beginning behind the curve, even if we can discuss whether or not at the end it did matter. But one of the reasons you have to keep in mind that just before we were facing a period where many people, including many economists, were saying you will never achieve your 2% target, you are in a low-inflation trap, you are the new Japan. And so in this context, you know, even at the beginning when inflation started to rise, you know, the view from many, including it was also the case in the US, if you look at the strategy review, was to have some kind of asymmetry in the reaction function of the central bank. So with the benefit of insight, of course, that may explain why we are behind the curve, but you have to keep in mind from where we were coming.
Perfect, thanks very much. Maybe if you want to go about the question about are this monetary policy response that we saw after COVID was really not a monetary policy response, but was a response to financial stability because everybody was worried about banks, so they just did whatever it took, and we're now basically talking about the wrong problem. Who wants to take that one? John, you're looking at me very...
I was interested in a slightly different question.
But you can go ahead with that,
okay,
whichever you want.
There were two questions that caught my eye. The first one was on the level of total level of global debt, and the other on the limits to monetary policy. And I want to connect this to global resilience. When my home country Iceland was hit by a crisis in 2007, and our neighboring country Ireland, the key reason why they could respond so effectively to the crisis was that both countries had very low levels of public debt, and therefore they could massively increase public debt so as to respond to the crisis. They had fiscal capacity to deal with an unknown event that hit them. Over the past 15 years, I think we've been using up our global fiscal and monetary capacity to deal with a relatively small crisis and routine stimulus of the economy, so that we are now in a situation whereby if something bad happens, and I promise you something bad happens, globally we are in a very poor situation for dealing with such a challenge. And I think, when I think about the biggest mistake of the policy regime over the past 15 years is to respond too aggressively to something that's relatively unimportant, so as not to leave the monetary and fiscal authorities with enough dry powder to deal with the serious things, and I promise you they will happen.
Thanks very much. Do you want to have something more optimistic as a closure?
So the thing is that I have comments on a few questions. If you allow me, I would comment on two, but it may not pick all of the ones that you wish. First of all, on the role of fiscal policy, Javier was asking, is there a role on fiscal policy of bringing down inflation? And the answer is absolutely yes. This depends on the country. In the United States, for example, the fiscal expansion was overdone. I don't think there is any doubt about that. Since the fiscal expansion was overdone, if some of that is unwound, that would actually help the Fed. The central bank doesn't need to raise interest rates as much, doesn't need to tighten as much if fiscal policy adjusts. So of course there is a relationship between the two. On the relationship of public debt and the concerns you have, I think we do have the IMF in the room, so we need to acknowledge that the fiscal department has done very good work on this. We don't talk about it as much at this conference because it's a central banking conference, but yes, the IMF has recommendations on how to design more robust fiscal frameworks that central bankers are well advised to remind the governments to do. It's the governments that need to implement the fiscal frameworks that will gradually reduce the debt levels from the rate we are. While that is happening, what central banks should be doing is taking into account what is the role of fiscal stance for growth and inflation, and as they would normally in the course of implementing monetary policy and inflation targeting framework. That's standard. I want to comment a little bit on the last question, which is whether the mistake we saw with COVID relates to the experience of central banks after the global financial crisis. To some extent it does. To some extent, I believe in the case of the Fed and the ECB, for example, we did have an overcorrection. This can be documented quite easily. The case in both central banks, inflation was a few tenths, the ECB more than that, lower than desired before COVID. And we saw in the communication, both the Fed and the ECB communicated that they were changing their strategy to tolerate temporary spikes in inflation, which was just a terrible change in strategy. It was a mistake. So yes, we did have a reaction a terrible reaction. This is one of those things where rather than learning from the basics and sticking to the basics, we had an overcorrection to something that happened a decade ago, which in the case of the Fed, I don't think was a policy mistake. In the case of the Fed, you can explain inflation being about 0.3% below 2, simply because our star was misestimated and it was being used to calibrate monetary policy. The case of the ECB, in real time, we know that the ECB did not forcefully correct for the insufficient fiscal expansion in the euro area. So the ECB committed a mistake back then. Yeah, I was part of that mistake, and we ended up with too low inflation. But that doesn't give an excuse for making yet another mistake and have too high inflation after COVID.
Okay, thank you very much. This was really good. I want to continue, but the protocol will kill me. So let's give a big round of applause to our panelists, and thank you very much.